안녕하세요. 한국경제신문 뉴욕특파원 박신영입니다. 오늘은 프랭클린 템플턴의 수석 시장전략가 스티븐 도버 씨를 인터뷰합니다. 도버 씨는 프랭클린 템플턴 전체 투자 전략 등을 수립하는 최고 리더 중 한 명입니다. There's been a lot event in the market like tariff. The U.S. Court of International Trade, so-called CIT, has blocked the implementation of reciprocal tariff, but President Trump quickly responded by announcing a sharp increase steel tariff. And tensions between China and U.S. is escalating again. So despite these developments, the stock market seems relatively resilient. Do you think this resilience will continue in the second half of the year? And what is your outlook for the market end of this year?
I think that we want to be careful about looking at all the changes day to day. And that's what's going on with the market. The market's trying to look through and look at the future. So the idea that America wants to change its industrial policy and produce more locally is not just a Republican or a Trump concept. It would also be the case with the Democrats. The issue is how to go about that. The Republicans tend, right now anyway, to be more on tariffs, and the Democrats would be more with industrial policy. But I think it's important for your audience to know that this isn't just a Trump issue, that no matter who's president, America sees itself in a situation where it can no longer afford its foreign policy that it has in the past. It can't afford the military protection that it has. Very important to Korea. America is shifting from primarily being geared towards Europe to increasingly being looking out in Asia and sees China as the more likely problem in the future rather than Russia or issues in Europe. I think America middle class has lost its jobs and has a real serious political vacuum there. That was how Trump was reelected. So rightly or wrongly, he's trying to move jobs in that area. So I want to give a framework that this is a very long-term issue that won't just be a 4-year issue. That said, Trump himself is very volatile and it's very unclear what his negotiating strategy is. And within the Republican administration, not everyone agrees that tariffs, certainly the high tariffs that we have, are the best idea. So to try to address your issues, the market now sees Trump in a way that they didn't see him on April 2nd. April 2nd was a shock. Nobody thought that the tariffs were going to be that high. And then they thought maybe he really meant it, only to delay them later. So we don't know where we are with the tariffs. So to some degree, the market is kind of shrugging that off. Or another way of looking at it is on April 1st, the day before so-called Liberation Day, the market was priced for tariffs to average around 10%. And now with all the volatility back and forth, we're kind of in that same mode. When President Trump over the weekend doubles steel and aluminum tariffs, the market today is down, but it isn't down significantly because there's a shrug with that. That doesn't seem realistic. I think the other big issue with the market is it's looking forward to positive tax changes and to reductions in a lot of regulation. And both of those are very positive issues for the market. So all of that said, our view is that the projections for earnings right now are a bit too high, and we think earnings are likely to come down. We think that the market is likely to just pretty much be sideways with a certain amount of volatility. By the way, I'm talking about the American market. I'm happy to talk about overseas markets later. And we think that the market is broadening, which means there's better opportunities in stocks beyond the so-called Magnificent Seven. So if we look at the world right now, we look at American investors, but also overseas investors. Right now, they tend to be overweight the United States. So we don't think they're going to become more overweight the United States. If anything, they'll reduce the United States. We think the US dollar is likely to fall. And we think that the market is likely to broaden with earnings not going up. We're in an era where it's very hard to look at past economic data. I know you interview a lot of people and they talk about trends and they say this is like that. And it's very dangerous to say it's different this time, but we are coming out of COVID. I think the global situation, the global investment environment is really changing. And so I wouldn't rely on reversion to the mean in the same way we have been able to in the past.
Can S&P 500 defend 6,000 end of this year?
I think it'll be difficult. I think the real answer to your question is, if I can say humbly, I don't know. And the reason I don't know is because we're living in such a volatile time. So I would be careful with being overly certain in this time because not even President Trump's advisors know exactly what he's going to do. And we don't, with the situation with China, we don't know how China is going to react either. So when you have more volatility, you have to have a higher discount rate, which just means the market's not worth as much unless you have certainty. What's been strong? The consumer's been pretty strong. The actual numbers on the economy have been very strong. The soft numbers, the prediction of the future, are looking a little softer. But all that indicates is that there's a lot of uncertainty. If we had more certainty, even if we didn't like the result, I think we could defend the 6,000.
Not only institutional investor, but also individual investor has to prepare to change their strategy depend on the circumstances, you mean?
Yes. So we have more volatility. We have the US likely to be less the market leader than it has in the past. Why has the US been the market leader over the last 10 years or so? I think that there are three reasons. The first is, in essence, the Magnificent Seven, or the amazing technology stocks and their amazing earnings that have come through. That truly is exceptional. It's been heavily in the US, and it has disproportionately accounted for earnings growth as well as the growth in the market. The question is, will that continue? We think those are great companies and they will continue, but not as dramatically as before. The second thing is the United States has had more economic stimulus since COVID than the rest of the world. And that is now fading, even with Trump's new bill. So we think that it is likely that there will not be as much stimulus going forward. And in fact, particularly in Europe and somewhat potentially in China, there's going to be more stimulus. And the third is just the productivity of the United States has been pretty high over the last 10 years, especially compared to Europe. And we think that that's likely to change as well.
Another big issue is U.S. government deficit. So Treasury Secretary Scott Bessent has stated there is no risk of U.S. default, but market continue to worry about the growing fiscal deficit. What strategy would you advise bond investors to consider under these circumstances?
I don't think that there is any likelihood of a default on U.S. debt anytime in the near future. Now, why is that? That is because the U.S. gets to issue its own debt in the way that it wants to. So the U.S. can use inflation to get itself out of its debt. So that's not a default. It just makes the debt worth less. So over the last, many years, at least the last 10 years, foreign investors, like Koreans, have done well investing in U.S. treasuries because they've gotten a higher interest rate and they've had the great benefit of the dollar appreciating. We think going forward, the dollar is likely to fall. The dollar is likely to fall because it's at a record high, because we are going to have, as you said, a fiscal deficit, and because there is less confidence in the United States than there was in the past. The other thing that's very difficult now for the Federal Reserve is to know whether or not we are going to have inflation or whether we're going to have a recession, or worst case, we're going to have both, which basically means stagnation. So because of that, we think the Federal Reserve will take a while before it makes any decision to cut rates. And there's a possibility that it could even increase rates. That's where we've seen a lot of volatility. So what we are recommending in the United States for US investors is to be in the shorter end of duration, to be out there in sort of 2 years. We're also recommending for US investors that they look at investing outside of the United States. And we can talk about equity markets as well. But in fixed income, we think there are going to be opportunities outside of the United States. That's in short what we're thinking. We also think there's a lot of opportunities in terms of global debt within emerging markets, both dollar denominated and local currency denominated.
Treasury yields have come down slightly in recent days, but they remain higher than in April. And meanwhile, the dollar is weakening. As you say, dollar is likely to fall, which diverges from the usual pattern of rising yields strengthening the dollar. Do you think we are seeing the return of a sell America trend? You already answered, but could you explain more?
So I think the answer on the margin is yes. So if we look at 2024 or even the years before that, the place to invest was in the United States, particularly in the equity market, but also in fixed income. So we had a huge amount of flows, certainly from Europe, but also from Asia into the United States, supporting both the equity market as well as the fixed income market. So looking forward, I think it's unlikely that foreigners are likely to add to that. And there's some chance that they will take away from that. And that's nothing political. I'm not saying anything political at all. That said, in addition to that, there are some countries that are offended by the behavior of the United States, or they are just questioning the exceptionalism of the United States. And those people are very unlikely to invest more and might even pull back a little bit. And that could have a pretty big effect on the United States in terms of investment. If you think about what President Trump is trying to do, he's trying to build an industrial base within the United States. That takes tremendous capital investment. One thing that doesn't seem to be discussed very much is that the fiscal deficit and the trade deficit are related. Americans love to consume. 2/3 of our economy is consumption. Because we like to spend so much in the United States, both as consumers, but also our government likes to spend more. About 1/3 more than we bring in, we have to borrow from someone, and we borrow from the world. And we do that through running a trade deficit. So you have to solve both of those issues. And if you're not able to solve those issues, then we need foreign capital. But at the same time, we're scaring away foreign capital. President Trump believes that if America has better returns than the rest of the world, no matter what, people will invest. And of course, there's a certain amount of truth to that. But I do think that the view on the United States has turned more negative than it was before, particularly around the tariffs, than it was before President Trump was elected.
Elon Musk has pledged to focus more on Tesla after receiving the golden key from Trump. If he meets shareholder expectation, for example, shareholders want him working 40 hours a week, do you believe Tesla can regain momentum, or can it successfully compete with BYD?
Certainly the Tesla shareholders prefer to have Elon Musk focusing on the company rather than focusing on the US spending. So that's a positive. I think his next big event, which he thinks he's going to announce fairly shortly, is autonomous driving. But I think that Tesla and Elon Musk's behavior has pretty significantly harmed the brand Tesla. We saw that very recently in the sales numbers of Tesla out of Europe. And we see that in the Tesla numbers, even in China. Tesla was certainly a leader in electric vehicles, but unless it does new innovation, it's unlikely to be a leader. And it's at a much higher cost point. The Chinese manufacturers have really wonderful cars. We don't see them very much in the US, but when I travel in Asia, I see them. Really wonderful cars with lots of features at a lower cost point. And that's tremendous global competition for Tesla. So I think Tesla will have a very hard time going forward.
Trump is pressuring big tech, including Apple, to relocate its manufacturing to the US. However, as you have previously noted in the roundtable, the US lacks sufficient educated labor, and relocating would significantly raise product cost. On the other hand, maintaining operations in India or China risk 25% tariff, as President Trump threatened to Tim Cook. So do you still see relocation as unlikely given the current situation? And what decision would the shareholders prefer Apple to make?
Yes, so Apple has been very profitable by providing amazing technology in the United States and very low-end manufacturing in primarily China. That is made Apple very, very profitable. I think that the problem for Apple, as well as for the United States, is that it's not as simple. Manufacturing is not as simple as maybe many in America thought. That when you manufacture something, you also learn as you're manufacturing and you become more efficient, and you're able to move up and build higher quality products. We were just talking about electric vehicles, and that's been the case for electric vehicles as well. So I think that there's some confusion between technology, which is the high level design, and manufacturing, which is the assembly. So I think that it'll be very difficult because of the labor costs and because of the amazing infrastructure that China has developed to move that manufacturing down to the United States, and whether that is even worth doing. So I don't think that's actually likely to happen. Apple could only do that over a period of time, and it'd have to pretty dramatically increase automation within the United States. We don't have the population, especially with having fewer immigrants, to do the manufacturing. But it's a couple million people that China has employed just making Apple products. I think that the policy that everyone thought was going to work, including Apple after the first Trump administration, was moving out of China, but moving to Southeast Asia or even Korea, or anyway, outside of China. And so one of the big surprises, both for those countries, but also for the companies that moved, is that Trump is now having a tariff everywhere. So if I was to guess, and I have no insider information, I would guess that it's very unlikely that there will be a 25% tariff on Apple manufacturing outside of the United States, because it just can't switch. And it certainly would not be positive in the short term for Apple shareholders.
Some analysts in Wall Street or some members of Fed believe a rate cut before September is unlikely. And however, the broader trend of slowing inflation appears unchanged. As a result, investors are becoming more cautious about bank stock. Can I ask what your view is about bank stocks in these days?
So the first part of your question, we think there will be 1 to 2 interest rate cuts this year. I would go back to, if I may be, a little bit humble on that, in the sense that it's very hard to tell. What we haven't seen is the impacts of the tariffs. We haven't seen inflation from the tariffs at this point, but we haven't seen the impact. So we're in a situation where we don't exactly know what's going to happen. I say we, it's really the Fed that is in that situation. If we weren't concerned about the tariffs, or if the Fed was not concerned about the tariffs, I think there'd probably maybe even be 3 or 4 interest rate cuts this year. Kind of hard to tell exactly what's going to happen with interest rate cuts. But our analysts generally believe that there will be 2 this year.
Due to tariff impact, Walmart has signaled price increases, and Trump complained about that. And Target and Home Depot are taking a cautious stance. But weaker earnings are a concern. And meanwhile, Costco continues to show steady growth. What is your investment strategy for retail stocks in U.S. market?
Tariffs are a tax. that someone has to pay. So either the manufacturer overseas pays, which is what Trump thinks, or the company pays, or the consumer pays. The truth is, it'll be some combination of those three over a period of time. Tariffs definitely are a tax. And so that is coming back to the question that we were dealing before in terms of earnings. Tariffs are going to hurt retail earnings because retail has benefited more than any other, probably more than any other industry over the last 30 or 40 years by having very inexpensive products primarily produced from China. And I think that if there was an interview that was really important to listen to, it was when President Trump said, well, maybe girls don't need $2, maybe they just need $1. We really think about what is happening here. It is a restructuring of the US economy to reduce consumption and increase investment. And if you do that, that will have an impact on the retail, a negative impact on the retail stores. In a kind of interesting way, the US has to reduce consumption and increase manufacturing, and China has to reduce manufacturing and increase consumption. So we have these two countries, both of whom are out of balance, and that's causing this conflict between them.
Germany's stock market has recently shown strong momentum, while Europe's recovery is still incomplete. Some argue that German equities offer a more attractive entry point than US stocks. Do you hold a positive view on investing in German equities?
Yes. And at the end of at the beginning of this year, the end of last year, my comment was to invest outside the United States with the thesis that the dollar was going to fall and Europe particularly was relatively cheap compared to the United States. What I didn't know was going to happen was the massive fiscal stimulus that Germany has. Germany is probably the last developed country that has the ability to have fairly large economic stimulus. So as I told you before, one of the reasons America has been exceptional over the last 5 or 6 years is because of massive stimulus that we had out of the COVID crisis. Germany didn't do that, and Germany's doing it now. So I think the fiscal stimulus that's going on in Germany is very, very positive for the German economy, particularly if it's focused on two things. Defense, we can argue defense for a host of reasons isn't a pleasant industry, but it gives Germany the opportunity to move its industrial complex from automobiles to defense, to remake factories. And so that's a positive for Germany economy. And then the second area that Germany is focusing on is infrastructure, particularly energy infrastructure. And I make 2 points there. I think Germans would agree that they made a terrible mistake being overly dependent on Russia for its energy and China for its sales. So they're trying to change that. And Germany doesn't want to be dependent on imports of American energy. If you look at the trade deficit between the United States and Germany, a big portion of that is energy. Germany, like China and like India, doesn't have its own energy. That's import energy. So if all three of those countries can become more energy independent, then that makes them much stronger economies. So that's a long-winded answer to say why I'm positive on Germany. And Germany is the engine of Europe. So if Germany moves, the rest of Europe will as well. The downside for Germany is that productivity still hasn't increased, and Europeans don't have the innovation economy that the United States and actually even China have. So productivity ultimately is what moves the stock market and grows economies. So unless Germany kind of has a model that increases productivity, then over the longer term, it's unlikely to outperform.
You are known as a leading investment strategist, and you are experienced strategist and in the field. What key principles would you recommend for investors navigation today's environment of heightened uncertainty?
I think that the first thing to note right now is to be a bit humble. Because there's so much volatility and uncertainty out there, I'd be careful listening to someone who says, this is the way it's going to be, especially around the political situation within the United States. The reason I started my discussion in the way I did is because I'm trying to look at the longer term structural situation that's going to change over the next 5 or 10 years. That regardless who's in power in the United States or China or Russia is going to shift. What I think is that we are going to have a broadening of the market. It makes sense right now for investors to broaden their portfolios rather than narrow their portfolios. So investors made a lot of money the last 5 or 10 years if they just invested in a few US companies that were really quite exceptional. I think that's riskier going forward than it was in the past. So I think the question investors have to ask themselves with the geopolitical changes we have, with higher interest rates, and with a broadening economy, where are the best opportunities? And probably looking beyond stocks and bonds too. We didn't talk about cryptocurrencies, but that's certainly an area that's growing and probably could be part of portfolios as well as private assets.
I really appreciate your kindness and your thoughtful and insightful answer. Thank you so much.
It's my pleasure. I always enjoy talking to Korea and Koreans. So thank you very much.
Thank you very much. Bye bye.